taking much time because we have less time and people have also waited for us. So I think we'll go straight to the session. But to begin with, I just want to tell you that there are decades when nothing happens, and there are weeks when decades happen. And usually, risk doesn't come knocking the door. It's like in financial markets, things often go wrong rather than they go right. So I think it's the time where risk management or possibly risk balance is quite important, considering the volatility which we are seeing, particularly in the dollar index or global financial markets or equity markets, even boiling down into the currency market as well at the end of the day. So it's important first to understand what are the broader parameters where we feel volatility can increase and why there can be risk arising out of it, both from the domestic angle as well as from the global perspective. So if we talk about first the most talked event or the most talked person, Donald Trump, where obviously we all know that the US presidential elections took place in November, and Donald Trump emerged as a winner into that election results. Everyone is eyeing that on January 20, when he will be officially there on the chair of being the president of the United States. What kind of policy changes would be arising out of it, and what kind of impact we may see on the financial markets. So first, let's talk about the propaganda of what Donald Trump did say during his speech. I think someone is not on mute. Just one moment. Okay, so basically, if we talk about his propaganda during the election time, the main focus somewhere was on three parts. One was about having tariffs on countries like maybe China, Mexico, Canada, maybe even India. So that is one important part to understand, which can affect the global trade for all over the world, which can in turn obviously affect the growth. Second point was most important to understand was the immigration part, where the immigration policy could be more stringent. And if the immigration policy is more stringent, it can affect in two ways. One is the global economic performance, and second, it can also affect the global remittances at the end, because if there's policies on immigration which are tight, I think global remittances may be affected as well. And third, the talk was on the lower taxation. So this talk has already been in the past when he was president earlier. And if we talk about lower taxation, it has its own impact on the fiscal policy at large. So global capital flows can be affected if there is a taxation impact. So these three important criterias are to be noted. Once he's actually on chair, but yes, uh, people are reading too much also at the same time, because it's like even he has not announced anything yet. It was his propaganda, and things might change once he's here on board. But because of the tweets which we have seen in the past, recent past, I would talk about one threatening China about more tariffs, talking about the BRICS nation where 100% of tariffs may be imposed over them in case if they're looking forward for alternative or creation of alternative currency, or going against the dollar. So these tweets somewhere are indicating that the propaganda may come true, because we have seen historically how markets have behaved when such kind of announcements actually come into picture. But what would happen on the other hand? So for assuming if the tariffs are imposed on China, Mexico, Canada, my personal belief is that retaliation measures will also be equally announced, where now we are, or everyone is talking about one-sided tariffs. But we have seen in the past that China doesn't remain silent. Once this kind of actions are there, then two things happen. One, obviously, China usually retaliates by having tariffs on the US exports. That's one. And second, in such a scenario, they start devaluing their currency, that is CNY. So if they start devaluing their currency, that is the Chinese yuan, which is currently trading around 7.28. The recent highs were around 7.35. To my sense, if this happens, I think both these criteria will start playing into action. And if they start playing into action, I would not be even surprised that even CNH or CNY, we term it as Chinese yuan, may even touch 7.5. Again, if we draw a line of the relationship between Chinese yuan and dollar rupee, or maybe rupee particularly, I would say, then we move in tandem. So as and when the CNY or Chinese yuan starts depreciating, we tend to start depreciating also. Somewhere RBI also loosens its grip while in terms of intervention because of maintaining some kind of export competitiveness into the market. So it's a big risk that in case the tariffs comes into picture and China also equally retaliates with weakening of the CNY as well as imposing tariffs on the US exports, then Chinese yuan may weaken further. So that's one. Second, if we talk about the taxation point, personally, I believe there will be no taxation reduction, mainly because of a couple of reasons. One is they already are running a large deficit, a trade deficit which is huge. I think lower taxation may counterplay. So it possibly was a propaganda, but personally, I don't believe a taxation cut would be on cards immediately after he comes into picture. So I negate that. Secondly, I also believe there are limited opportunities for expenditure also, considering the large trade deficit. So this is another reason taxation cut may not come into place. Also, third point is most important, tax cuts and job cuts. These are also going hand in hand. So these three pointers are pointing that taxation cut may not happen. That's my personal view. But tariffs, yes, may get imposed, and immigration policies again can be a lethal part where global remittances may be affected. Now, how Fed would behave, because no one knows the nature of Trump and how would it behave. So we talked about the three important points, but basis on which how Fed would behave, if in case we are assuming that the things which we're talking about comes true, then inflation will start rising because the government spending will start increasing into the system, or the liquidity will increase in the system, which in turn will create more inflationary pressure. If more inflationary pressure is created, the Fed might have to take a call to rethink or realign the rate cut
तो
strategy
आरपी
what
तुला
they
मेरे
have
सांग
asked
आरपी
for.
तुला सांग मला ये केस में मेरे को
Yeah, sorry. So basically, I believe that the Fed rate trajectory might slower because ultimately, if inflationary pressure begins, in fact, even if we talk about the December policy, initially when we started a couple of weeks back, it was almost 50-50. But then, because of the robust data points which came in from the US front, it got more confident that, okay, we see a quarter basis point cut at the December policy, which is due on 18th. So, one policy, obviously, rate cut is definitely been seen now on cards. Uh, but to continue it, my personal opinion or projection remains of 3 to 4 maximum rate cuts. In fact, three to be more precise, of 75 basis overall rate cut for the next year by the Fed. So I believe the rate should go towards maybe around two half three, uh, to the max on the lower front. I mean, 3% will be too high to be optimistic, but not below that. The Fed funds rate. Also, if we talk about aligning the same thing, if we go to the European policy, if we talk about the European Central Bank, we saw the European Central Bank, as expected, cut its rate by 25 basis point yesterday. The major point was not the rate cut because obviously it was aligned and in sync, but the message was too dovish. And by dovish, I mean there were members who were even talking about a 50 basis rate cut, in the same current policy. There are a couple of reasons again aligned to it. One, obviously, the investments have dried up. Secondly, the poverty levels have started increasing a lot. Third, the concerns with respect to the US tariffs in case so trade related problems may start creeping in. That's what the anticipation is. The job creation has gone to much lower levels. There are a lot of job cuts happening there. When we align all these four issues, it clearly tells that growth definitely is very less because investment opportunities or exports even are drying up. So even when I speak to a lot of clients who have been doing exports to Europe, talking about maybe steel company for an example, they have all not even for a couple of months, they are all thinking that next 1.5 years, Europe will still continue to suffer in terms of demand itself, where because the internal consumption is not required that much, where the supply is so much ready from all the countries. So European economy may struggle. Secondly, if we talk about also the political angle, if we talk about the Europe, uh, it's like the France or the French politics particularly. I'm not sure how many people might be aware or reading about it, but it's also getting very important to watch out, and it can affect the euro dollar pair also. So if we talk about the Barnier was elected as the key member. I mean, the last year, this year, in fact, couple of months back, where Le Pen was the most favorite at that point in time, and that was quite a surprise to every single person on street that Le Pen did not go ahead and uh, uh, Bania went ahead with the election. But now we are seeing things have been, the no confidence vote coming into picture. If we talk about a fiscal deficit, or the total deficit has almost doubled in the last 7 years, from almost 2 trillion euros to 3.2 trillion euros now. The economy itself is struggling in terms of demand supply issues, and that is why Le Pen is now trying to take an advantage and trying to gain the vote share again. Now, actually, the presidential election is in 2027, and not next year or even next to next year. But obviously, considering these scenarios playing into picture, and even history tells us that presidential elections can be preponed, and Le Pen is eyeing the same thing, where Macron remains the president at this point in time, but somewhere the push is that we can have the elections next year itself, which is an important event, and the feeds should be completely watched. It cannot be ignored. If I draw a line of what do I anticipate into the euro dollar pair in terms of number, because I'm sure the participants are more importantly watching even what the dollar pair may be. So my belief is there is space till 1.0330 on the euro dollar pair, and on the right side till the point we do not cross the resistance level of 1.0680. I think it still remains under pressure because of obviously dollar bullishness and plus their internal issues as well. So both are against them. So euro dollar pair may see testing 1.0330 levels also, with an important resistance line of 1.0680. Now let's draw this line towards the Bank of England. So as we are going ahead, we are trying to first cause the global perspective, and thus we're talking about every economy, and then we'll also draw down into our economy and what's happening with rupee. So if I talk about the Bank of England, they are suffering with inflation still. If we talk about their last number, it was 2.3%, the CPI year on year, which was above the estimates of 2.2%. Their core CPI was at 3.2%, again above the expectations of 3.1%. Most important in UK is the services inflation, which every person watches who understands market. The services inflation is still at 5%, again below the estimate of 4.9%. So they are still struggling with this inflationary pressure. And also there remains a divide between some members and the governor, Andrew Bailey. So Andrew Bailey is of the opinion that the price pressures may still persist and it may continue, and thus is of the opinion that rate cut at this point in time is not right. A couple of members into their policy making are still of the belief that maybe one rate cut is required. But if you ask me my personal opinion, I believe we may not see a rate cut from the Bank of England, though we have seen from SNB, Bank of Canada, ECB, now by Fed. So four central banks, are there on the rate cut part. But I think Bank of England may wait because of their internal dynamics, which is not supporting them. But again, if we go to the opposite side of it, if we talk about the Bank of Japan, somewhere the feeds are coming off a rate hike because of a couple of reasons. One, their inflation is persistently being above 2%. At the same time, the growth is also going good. When the growth is going good, I think, initially, historically, they did cut rates or they went negative because of the growth reasons. But now growth is not a problem and they are also in sync. They think rate hike can be on cards. Third, if we talk about the job creation, standing today, this job creation is moved towards the highest level since November 1992. So that's the gap, and more job creations are or to the highest level since so many years. They have gone to a highest level since 1992. So all these three factors are definitely indicating towards a rate hike. But as I said, because of the global dynamics and Trump policies may take place after the January month, I personally believe that maybe they will skip one policy for that rate hike, and possibly after that they may rethink or re-strategize in terms of do they really want to go for a rate hike. So I believe one pause before a hike. That's my sense. Though we have seen dollar JPY levels at around 150 to 153 levels now, my personal opinion in terms of if I draw my support and resistances, 146 half remains an extremely important support from here on. In fact, even if you want to draw a narrow line, then 148.60 remains a very important support, while on the contrary, 155.80 remains a very important resistance line. So, though dollar JPY has always been more volatile and thus, a wider range for dollar JPY because it can move as good as even 3 to 4 begin in one single day or possibly in even in half an hour also. So, this broadly remains a range of 146 half odd levels till 155.80 and narrow range 148.60 to 155 half or 155.80 zone. Now let's understand and boil down to the dynamics of CNH because as we discussed that after the policy making and there was stimulus measures into picture, a lot of inflows had been seen straight away once after the stimulus or easing measures have been announced by the Chinese economy. But overall, personally, I believe Chinese economy is more like a black box. No one really can understand how China fares. Uh, all we understand is what we read. So it's very difficult to understand the policies. And that's why we also saw that the reversal of the flows from China also started back. It was just a week where they rallied almost 21% on their equities. But then obviously it soothed off and then it cooled off suddenly. So as I said, China looks like a black box to me. But the tariff part can make the Chinese economy more volatile and thus the Chinese yuan play will be the most important part which I would look forward for because if Asian currencies start depreciating like Chinese yuan, South Korean won, Indonesian rupiah, then rupee also tends to depreciate. It does not shy away, or the intervention possibly may remains more shallow. So, Asian currencies, particularly Chinese yuan, will be under my eye. And I see it depreciating further from here immediately, at least towards 7.35. On the lower end, if I talk about the support level for Chinese yuan, then I believe 7.19 acts as an important support for me. Only then I see a reversal. Otherwise, I think I'll still be bullish on this, or the weakening of Chinese yuan will be far more important to watch out. Similarly, if I go to the geopolitical issues, particularly talking about the Brent crude, the geopolitical issues still continue to prevail. Feeds come on and off, both with respect to the Middle East crisis as well as on the Russia-Ukraine front. But broadly, I still believe demand and supply mismatch continues, and the demand for oil is not still that much, considering a lot of geopolitical risk factored in both from the political angle, secondly, from the angle of the central banks, plus their own personal Middle East crisis. So I think, irrespective of these crises, I don't see a far-fetched rally in terms of crude. So I believe 68, 69 may act as a base, possibly an immediate base. But on the right side, 77, 78 acts as a decent resistance. So I'm talking about Brent crude prices. Basically, $78 per barrel may act as an important barometer on the right side. We have seen a bounce from $69 to even 84, 85. But now I believe that 69 to 78, would be a broader band play, which for India it's a comfortable band because though we are also importing oil from Russia, so we are not dependent now, and plus we are also getting cheaper oil as compared to what we were getting earlier. So the trade dynamics or the fiscal deficit dynamics does not hurt us if this range play takes place. Now, what do we foresee when we talk about, we already touched base on all the important parameters from the global perspective. But if we talk about specifically INR, because a lot of action has been happening in the dollar rupee pair of lately, the trigger point definitely was the BRICS statement, which definitely pushed the INR or the weakened the INR pair on the right side. NDF levels did play even as high as 84.93, the traded highs. But obviously there were reasons apart from the new governor coming into picture. So the speculation remains that would the intervention policy be the same or the liquidity measures would remain the same. So there are too many questions, but let's boil down and let's take 10 minutes just to understand first the broader domestic perspective. So first, if we talk about the GDP number, that was itself a surprising number of 5.4%. The anticipation had remained almost of a 6.5% on an average. So almost we'd say almost 110 basis point of not so anticipated bad number, and the difference was huge. And this markets also reacted on that part. Uh, when the reaction came, central banks were in a fix that what to capture first, growth or the liquidity measures. And I think the RBI rightly first focused on the liquidity measures, considering the uncertainties we can hold starting next month, Jan Feb, particularly after the policy changes, and even our budget will be announced. So they focused on infusing more liquidity by having a CRR cut into two-phased way, and it would infuse around 1.16 lakh uh, crores of liquidity. But would this liquidity be of sufficient? The answer to me is no, because liquidity for me still remains tight for next 3 months, not even today or tomorrow, this month. One, because of the GST, outflows happening. Advanced tax outflows will be also happening in this month itself, and this itself will be much higher than the 1.16 trillion rupee of the infusion of liquidity into the market. So liquidity will still remain tight. That's what I understand. Though the rational and at least some kind of easing is definitely seen, but on the contrary, a lot of paying interest has been seen into the market. We'll come back to that. But again, coming to the macro number, the GDP number did not fare well, and that is something. Even when the policy was announced, they also revised their GDP numbers lower. But if we talk about the global economy and India's growth, it still remains much higher as compared to any other nation. So we still are to be believed as one of the best in terms of our delivering of growth. So I'm more optimistic on the growth perspective that it may start rising, and on an average, I personally believe that we would go towards 6.5 to 6.7% for the next year as our GDP target. On the other side, if we talk about inflation, because inflation and growth dynamics always play hand in hand, it's important to watch out. We did see a spike into the CPI number to 6.2%. And then yesterday, the numbers, as expected, came in lower because of the moderation seen in the food inflation. Though I would not say the moderation is too sharp, the inflation number came in at around 5.48%, the CPI number. But still, I think the elevated prices still continue to or may continue to dominate, considering the liquidity conditions also for the next 3 months. So my take would be that the inflation may remain around these levels, around 5.25 to 5.75% for the next 2 to 3 months also. And then after March, it will start soothing, maybe below 5 or 4.5 is the average, which I'm eyeing, where the inflation levels would turn into after 3 months. Also, if we talk about the food inflation number, it came in at around 9.04%. The earlier figure was around 10.5%, somewhere between that. So it has cooled off. As I said, it's not cooled off that sharply. So inflation trajectory continues to be a dominant part, which cannot be ignored. Now let's move on to the flows part. If we talk about dollar rupee flows, remain the most crucial to understand. And the FPI flows, if we talk about the month of October and November, they were negative. October had been to the tune of 94,000 crores outflows from equities. If we talk about November, the outflows were to the tune of 21,000 crores. But if we talk about the month of December till date, we have seen inflows to the tune of 26,000 crores in equities and around 5,000 to 6,000 crores in debt. So basically, this remains positive at this point. But personal opinion remains that it being a book closing and a financial year end for the offshore countries, maybe in the last week or till Christmas or after Christmas, we may see certain outflows picking up. So I wouldn't be that bullish in terms of the flows at this point in time. Though we have been uh, decent enough flows have been generated at least for the month of December till now. So I think I'm content with the flows which we have seen, though maybe we see it closing flattish uh, or maybe single digit by the year end. But flows may overall remain positive. Debt flows were very good for the year 2024. Almost to the tune of 1,12,000 crores of debt flows were seen. But equity flows, if we talk about the entire year, I think I would say it's more flattish. It's not maybe 12 to 15,000 crores of inflows overall after inflows and outflows of certain months. Uh, Now people are talking about that what exactly happened to rupee and why we have seen levels of even 84.90 being traded. First, we need to understand that since September 2024, dollar has appreciated by 5% across currency pairs. If we talk about 13 DM or EM currency pairs, they have depreciated beyond 5% in the last 3 months itself, or particularly last 2 months. So I think it's not a surprise because DMEMs have depreciated around 5% or beyond 5%. Even countries like or currencies like Russian ruble, or if we talk about Brazilian real, they have depreciated much higher in two digits, like 12 to 19% on an average of depreciation they have seen. But if we talk about INR, I think we have only seen a depreciation to the tune of 1%. So if I think that, I think the depreciation is still not that sharp to be worried. Intervention we have definitely seen in parts and parcel. Uh, but what happened in September 2024? The data points of US were the first trigger points which were optimistic, and thus dollar started moving up, the dollar index. Followed in October, November, the Trump feed started coming in, and in November, once presidential elections result were out, uh, obviously Dollar Trump was more considered to be a dollar hawk, and that's what was seen because of his policies, which possibly may be implemented. So dollar index did rally after that also. So these factors did contribute, but as I said, the weakness for INR is still not massive. Uh, if we talk about the other parameters which are important to watch out is the FDI flows, because those are possibly the longer tenor flows which cannot be ignored. I think we still are at near decadal lows, where FDI flows are quite important to have a longer term money, because FPI is more of a hot money which comes in and out. So uh, it remains quite crucial if we see some growth perspectives. And somewhere the consensus remains amongst the market participants also that why are we having a dollar rupee which is almost either pegged or not much of volatility. Even if we talk about the volatility curve, it's at multi-year low. Why are we maintaining that? So certain point of context remains that in order to build or attract more flows, one possibly needs a stable currency. And for one stable currency is what possibly India is trying for, where in a longer trajectory, we attract more funds. So somewhere the mindset is that. On the other hand, if we also think that demand and supply should determine the value of a currency, I would not completely also agree and not also disagree. So there are times where one needs to intervene, where there is some kind of excessive volatility or uncertain volatility which can create disparities into the system. So if I talk about the FX reserves data, which highlights something to us, is we saw the recent highs of $704 billion of FX reserves couple of months back, and then we saw a drop towards $656 billion. So almost nearly 45 to $50 billion of FX reserves getting depleted. One of the major reasons obviously was FCA, where it got revalued, and which are the non-US currency units, they got the revaluation. So around $33 billion out of this 49 billion was because of it. But the rest has been more on the intervention part, due to which we saw less volatility into the INR as compared to the other Asian peers. So one important thing to note is what is the import cover now, because on a long average horizon, the import cover is roughly of around 11 months. But in the last month, in September to October month, we had around 10.4 months of import cover, which has now dropped because of the FX reserves being depleted. It's dropped to around 9.5 months now. So we are below the 10 month of import cover, but it doesn't matter. Usually we have seen even below 9 months, also 8.5 months to 9 months. So I think that's not a concern. But it also highlights one factor that given the depletion of RBI reserves plus the depreciation of rupee, we do not eye much sharp appreciation in rupee, because there is not much major inflows which are expected. JP Morgan bond index flows that has been coming to the tune of 1.5 billion. Obviously, they are almost there now. It's over. Bloomberg index, where inclusion will be happening, those may have maximum of $3 to $5 billion of inflows. So not much expected from the flows front. Policy front, somewhere if we see some kind of growth trajectory of fiscal spending more, that can possibly add. But RBI possibly might take an advantage in case if we see some kind of appreciation. So broadly, I believe, now, on an average, if we talk about the last couple of years where the intervention has been more sharp, the average CAGR depreciation or annualized depreciation was to the tune of 3 to 3.2%. That was the overall depreciation in an intervened phase. But now, if we talk about moving from here, I personally believe the depreciation for next year will be around 2.5% to 2.6%, as per the models which I have run. So I think 2.5 to 2.6% will be the annualized depreciation expected from here, considering the rate trajectory movement and the rate cuts coming by Fed, and RBI may follow the suit maybe from February or after that policy, where the liquidity conditions may be assessed and the data points and inflationary angle will be reassessed. So 2.6% of depreciation. So my range now for 2025 continues to be on a depreciating front, between 84 half and 86 is the broader range, is what I am expecting a play. Only a close or any kind of positive element surprises if we go or close below 83.80, 83.90, then there is some phase but of sharp appreciation seen. But at this point in time, as I said, possibly RBI might want to take such opportunity in case if we are seeing those levels due to any reasons. So not much downside in INR. That's what my personal opinion is, and depreciation may continue in a slow and phased manner. One important point to consider is what's happening with the swaps, because a lot of questions may be turned around that initially that the premium started depleting. If I talk about 1 year premium, 1 year forward premium for dollar rupee, it went down to around 2% or below 2% also. Now, in the last couple of sessions, we are seeing the premiums have even spiked to 2.25%. The overnight levels or the cash tom overnight or tom spot levels have started rising. So what's the reason behind it? First important reason is the arbitrage opportunities which we started seeing now, where NDF is quoting at a premium. And why it is quoting at a premium? Because the demand for dollar is much higher considering the uncertainties which can prevail. So the NDF is quoting higher. And on the onshore market, we are quoting at a discount as compared to them. So the RBI, arbitrage opportunities does arise between NDF and onshore. But before this, there were a lot of buy-sell swaps which were seen, and due to those interventions, we had seen that forwards did drop. But in last couple of sessions, it has completely reversed because the arbitrage opportunities has been quite attractive. So there has been a lot of sell-buy swaps which are seen in the market. Now, sell-buy swaps work in two ways. One, obviously, it also provides liquidity more to the market because of the sell-buy swaps. Plus, after the announcement of the CRR cut, so it acts in the favor of liquidity though. But considering the spot not being that volatile as compared to the forward being more volatile, so one needs to watch out these liquidity conditions more tighter, because it's not only about the FX market. Such kind of paying also affects the money market. And if money markets are affected, the yields have also, in fact, day or yesterday or day before yesterday, we had seen sharp drop in the money market yields because of the more paying interest seen into the market by the market participants. So that way, money market yields did soften by almost 50 basis also into the market during a day. So it's important that how the management of RBI remains taking care of both the intervention front as well as understanding the liquidity conditions into the market. It remains tricky. So even if I talk about a normal, like if you're going for travel, and if you ask any of your broker or maybe a money exchanger that, okay, I want maybe $1,000 or $5,000, what would be the rate you will give me? Usually, on an average, the spread remains 30, 40 paisa. But now it's much beyond that because the demand for dollar is so much. Such things are also a reflection that why we are weakening is because even the physical demand of dollar has been on the peak where people are charging 80 paisa, 90 paisa, even for a note of dollar. So I think it also clearly indicates how much the demand for dollar is or how much deficit remains into our system. Uh, I would not take much time into dwelling more into the nitty-gritties, but broadly, to finish it on time, the broader range for me remains immediately as 84 half and 85 half, with the flyers remaining to 84.20 and 84, 85, 80, 86 band. I don't see much appreciation at this point in time, and RBI may be we be present at lower levels in order to boost up their FX reserves, because there may be a lot of uncertainties prevailing into the coming year. Now, lastly, where people who are into the business of exports, imports, or on the trading front, what my strategy would be in order to hedge or maybe trade. Particularly for dollar rupee for exporters, I see obviously one rate cut by the Fed, and maybe a pause by RBI, obviously seen the recent one, but even Feb remains a bit dicey. We see a rate cut or no, still it remains questionable. So I don't see a very sharp drop into the forward premiums considering the demand still prevails, though we see a rate cut. So the forward premiums may still be about 2% annualized. And plus the spot remains in favor of an exporter. So for an exporter, I would recommend where they should hedge themselves into a staggered manner rather than, all going at one go. Because they may get better levels also, in terms of the higher hedge, but no one in the market can catch a top or a bottom. So it's always better to hedge in a staggered manner. And our strategy remains that at the current juncture, the levels which you're seeing of 84.90, 84.80, 84.90, at least 30% of your exposure, at least for the near 3 months, should be hedged with a mental stop of around 80, 84.40 odd levels or 84.50 odd levels. Uh, in case if we are now, there are two ways to look at it. If in case we are going above 85, then we have some leeway to wait and watch of how the market behaves and where the equilibrium comes into picture. But in case if we are going below 84 half, I think 20% more should be added there, though it's a lower level, but I think it's about mitigating and understanding the risk into perspective. So 20% should be added in case if you're going below 84.40, 83, 84.50 odd levels. And in case if this doesn't happen and the other criteria comes into picture where we are going beyond 85, I would say to pause, not even to hedge for some time, assess the situation, and if we find an equilibrium of somewhere around 85, 20, 25, then I think we should add another 30% and remain open on the 40%. So that's what our personal recommendation would be for an exporter. For an importer, I would be more inclined to use options rather than going for forwards because option offers a double P approach, participation as well as protection. So and plus, as I said, that in terms of volatility, we are at multi-year lows. So at comparatively lower forward premiums, we should hedge some portion of our imports and not wait for any kind of sharp appreciation. So if we are seeing levels of 84.70, 80, though we have seen today touching 84.80, so there can be some 10 paisa move plus minus. So if we are getting those levels, we should use options as a tool to partially hedge our exposure, maybe around 35%. That's our suggestion based on the model. And uh, wait till the point we are not breaching the NDF traded highs of 84.93. If they are in sync, then we can wait with our positions of 35% hedge. In case if it's moving below, we should add 30% more if it is moving 30 paisa lower than our hedge, assuming if we have hedge at 84.70, 75, then around 84.20, 40 band, if we are getting those levels, we should add more options by 20, 25% and be hedged at those levels. On the contrary, if we are seeing levels rising beyond 85, these options are obviously protecting us. But we can have a mixed blend depending on the cost of the company. Basically, whenever we are importing and exporting, we know which is the pain area or which is the cost which is affecting us. So if you know that your costing is hitting you badly at around 85, 85, 20, you should be around 84.93, which is NDF traded highs. We should add more hedge because a lot of stops can be triggered at around those levels and a move of 20 paisa can be seen higher. So addition of more import cover can be added if we see our levels touching 84.93 or crossing that. We can add 25% more of options and wait for an equilibrium or sustenance where the intervention policy takes place or where we are finding again an equilibrium. So this is for broadly an exporter and importer. For the trading perspective, I think buy on dip still continues to remain a better strategy. Yes, but stops should be in place, and I would personally recommend that rather than dollar rupee, I think crosses are more relevant because crosses are more developed in nature. You can refine your stops very clearly. There are no big moves that can, uh, because of the intervention, which can affect your currency pair, because the liquidity is quite high in terms of the emerging currencies or the developed currencies like euro dollar or dollar GPY or GBP dollar. So for the ranges for euro dollar, I will just reiterate 1.0330 is what I'm expecting, and a stop remains 1.0680. If I talk about GBP USD, 1.2480 and 1.2890 is the broader play. For dollar JPY, 146.80 or 148.80 to 155 half or 155.80 is what the broader plays. And for dollar rupee, as we already discussed, that slow steady depreciation may be seen with an immediate support at 84 half levels. Well, wouldn't take much time. I'm open for Q&A or any suggestions, feedback for the session. Over to you, to the PhillipCapital guys.
Yeah, thank you, Kunal sir. Uh, Yes, so of course it has been a very detailed, webinar wherein you've covered almost everything that is in the current scenario impacting not only the rupee, but as you started with all detailed discussions on every single measure, which boil down to how we should react as an importer or an exporter um, to hedge our risk. So thank you very much for those details. And yes, as you said, the floor is open for questions. So anybody having any questions can straight away unmute yourself and ask the questions, please.
So I can actually see a veteran, Anil Bansali ji. So my
Yeah.
regards to you, Anil ji. Thanks for being here.
Hello. Thank you so much, Kunal, for
Yeah,
calling my
my
name.
pleasure.
It
My
was
pleasure.
great.
Thanks.
It was a great session, covering all the aspects actually. Not most of the aspects. It was all the aspects which are affecting the global economy, the Indian markets, and particularly the dollar rupee. So most of my points, which I also look into, are matching with yours. So thank you so
In
much.
fact, I learn a lot from you, to be very honest. You being a veteran and you have a lot of experience. I'm still on a learning phase, I would say, but thanks for your views also. That's really highly appreciated.
Thank you. Thank you so much. Thank you.
Well, it seems there's no questions as such because probably, it has been so much of a detailed conversation, discussion that you have had. Um, Apart from the views and everything, I don't think there would be any, even any questions regarding what could be a view on euro dollar or pound for that matter. Because yes, it's pretty much clear as to what you have given all the supports and resistance for Euro USD as well, and for Japanese yen as well. So,
I think
I
someone
think,
has raised their hand.
okay,
We can check.
yeah. Uh, yeah, you can please go ahead with your question if there's any.
Yeah. Kunal, hi Jay here.
Hi, Jay.
Yeah. So you have spoken that you are seeing Chinese people are going, Chinese yuan going to depreciate towards 7.5 or 7.8. That that scenario where you see the rupee.
So given that scenario, so not 7.8, but 7.5, 7.6 is for the next year. I think there is a possibility. And considering the depreciation, if this happens or the weakening happens, I believe obviously rupee remains in a controlled environment continuously. But then 85 half is what the levels I would see in case if we are going to touch 7 half. If that's in fact even after 735, which was the recent highs which I have seen last. Even if we breach at 735, a bit of panic may appear into the rupee market also. So I think 85 half is what I would see in case if we are seeing right rest all other parameters remain constant, nothing changes there domestically as well as globally, and isolation if you're talking about this, then yes, 85 40 85 half can be seen.
Okay, and just one more, that if DXY uh,
Hmm.
moving towards 112 or 113.
Right. So basically, what I have observed for dollar rupee particularly, I may be wrong, but then that's my sense that dollar index and dollar rupee has not been in sync at all. Like if we talk about dollar index at 100, and if we talk about dollar index at even 108, we didn't move that much, when I talk about particularly rupee. So I would not dictate a direct level from dollar index for dollar rupee, because possibly I'm not seeing that direct sync. But yes, it obviously creates a dollar bullishness. But hand in hand, if Chinese yuan or Asian currencies also depreciate, then that's a bigger risk. But in solo, if dollar index moves towards 109, 110, technically 109.90 is what I am eyeing, with a base of 104.75 being important support. I do not see a direct correlation and a sharp move. Maybe if those kind of levels come, I would assess more other parameters in order to get a level for dollar rupee. So it's like my answer to that. We've made depreciate, but not sharply.
Do you see parity in euro next year, by next year?
Difficult to say because no one knows what Trump will come out. It all depends on what policies are laid down and the way people like us or media or analysts or economists are believing. In case, the severity is beyond what we are thinking, then there could be a chance. But as of now, I think 1.0330 for me remains a very, very important support to watch out. I would not jump that gun because there are a lot of uncertainties with respect to policy framework. Uh, Technically, as I said, on charts, if you are asking me, then 1.0330, beyond which I am not eyeing at this point in time, at least for this month.
Okay, thanks a lot. Thank you.
Thank you, Jay. I think one more, I think Hardik was there, I guess. I think he has put a question on chat. For euro dollar, near term view is it depreciation? So as I said, I see euro dollar moving a bit lower. It's not sustaining even 1.0580 levels. It's been trying to go there and move beyond. Same goes for dollar index, vice versa, because the weightage of euro in dollar index is almost around 59%. So if dollar index is still moving ahead or higher, then obviously euro dollar will come lower. Uh, so dollar index, my view is a bit bullish, and thus I would be still on a bearish view for euro dollar, being a bit lower from here also.
Okay, hi Kunal, this is Hardik. Okay,
Yes, Hardik.
yes. So what are the data points that you are looking for euro dollar pair in near term? What are the important data points that will be there? And
Mhm.
are you seeing euro dollar pair going above 1.06? Matlab in any chance?
So technically there can be a chance for a spike, but it should be sold off. That's what I feel. Important things which I watch out is one, obviously the political angle, because no one possibly is giving that importance as of now to that political front of the French elections. But a couple of months back, the same scenario was extremely important for the markets, and euro dollar even went till 1.1 to 1.13, and then the drama started, and then we started falling, and rest were added, that inflation plus other stuff. So for me, I think that aspect plus demand pickup, because I think uh, to whomsoever corporates I'm speaking to, there is not much demand there. Everyone is eyeing that the demand may take a lot of time to pick up. They have no orders for past, I mean, for 6 months, even from now. Very minimal orders. Like I would say that usual orders, if someone is having orders of maybe 100 crores, they may have only of 20 crores. So demand remains weak for me. And plus, in case if the tariff angle will also be equally important, because if in case if that takes place, it will also be on the European countries. And if, in case if that is the case, growth further will be questioned. So they are in a very fixed situation at this point in time, both from political angle as well as from the economic perspective. So as I said, to boil down into your question, geopolitical, as in the political factors. Secondly, eyeing any kind of tariffs if imposed on Europe. Demand pickup, do we see or no? there is no investment which is going there, not only internally but even externally. So I think if the investment or possibly if you talk about the FDI angle flowing more there, as of now it's not an eye there. So this, and secondly, as we already spoke in the speech, that even the jobs are, people are getting more jobless. The rate is, phenomenally bad. I would say that the job cuts are higher. So all in all, not a good phase. These five things or the five data points I'll keep on looking: jobs, inflation, tariffs, and the political angle.
Okay. Okay. Thank you. Thank you. Thank you. Yes.
Welcome.
Hi, Kunal, Malvika here.
Yeah, hi Malvika.
Hi, just I heard you talk about how you see the rupee depreciate about 2.5% to 2.6% next year. I mean, the current level for this year is about 1.9 to 2%.
Correct.
So that's not a very, it's a very stable outlook. Like it's not a very, far off, like 0.5% or roundabout in that
Hmm.
area.
Right.
Is that including the risk of tariffs? Like, the fact that Trump might just come around and,
Right. So basically,
enforce it? Yeah.
mhm. So basically, when I'm talking about 2.5 to 2.6% depreciation, is from the current levels. And so it's not a difference that we have depreciated by 1.92% and the remaining is 0.6%. So I'm talking about if the current levels are 84.80, from here we can see a depreciation towards 2.5 to 2.6% from the current level, considering even the tariffs into picture. See, some things markets are always forward looking. So there are things which markets are also discounting that these kind of things will turn up, and the the effect may not be as linear as the announcement. So that's what I mean to say is, in case a tariff is announced and we see a 50 paisa move, I don't see that way. We may depreciate, yes, but I think slow, steady depreciation is what we have been seeing since last couple of years. This may continue to be followed even in the regime of the new governor. As the press conference also was there, that he may live up to the legacy of what was there in the past, which possibly suggests somewhere that this may continue, and we don't see any sharp volatility or sharp INR depreciation at one go or in couple of sessions. So I think slow, steady depreciation is what but as I said, 2.6% from the current levels. So does it answer you, like Malvika?
Yeah, yeah. No, I don't understand that. No. It's just
Okay.
2.6 would just be like point 0.6 from status quo where we are this year. So
Okay.
sorry, yeah, I think I framed the question wrong, but
No, no,
thank
no,
you.
no
Yeah.
worries.
Yeah,
But
yeah,
good
thanks.
that you clarified. It benefits
Yeah,
the audience
yeah.
at large.
Any further questions, guys? I don't see any questions coming. Uh,
But just want to thank all the participants for their time. And I know, webinar now is a bit out of date thing because it started with COVID, and usually people don't turn up on webinars. It's more a physical meeting or networking. But thanks for people who have turned up for your time. And I hope the time was equally delivered and valued in the analysis.
Absolutely. Yes, okay. So, thank you all the participants. On behalf of everybody who has attended, I would want to extend my heartfelt thanks to you, Kunal sir, for your insightful webinar that you've conducted today. And as always, it is your expertise and clear explanations that you uh, always bring into your webinars or seminars. It is really very helpful and truly enlightening. Also, the way that you've broken down such complex topics today, right from Chinese stimulus and Bank of Japan policies and everything. So all those things which you have broken down, making it accessible to all the audience. It's remarkable as always. So thank you very much for
Thank you
your
so
time
much.
as well
Thank you.
to join in with PhillipCapital and having conducted this webinar. And I hope we'll continue to be in touch and keep arranging such webinars in near future as well. So thank you very much from PhillipCapital to you, sir, and to all the participants as well. So I
Thank you
think
so much.
we can wind up the call now. So thank you very much, sir.
Thank you so much. Thanks.
Thank
Thank you,
you.
everyone.
Thank you.